Hello, my name is Alex Fowler, and this briefing has been prepared for a newly elected member of the Parliament and the executive team of a retail bank the morning after Budget 2025. Over the next 10 minutes, I want to walk you through three things: where UK monetary policy currently stands and how it transmits into the real economy, what Budget 25 actually means for markets, banks, and households when you look beneath the headlines, and what the emerging landscape of Islamic finance and digital money means for competition in retail banking going forward. The core question underpinning everything I'm about to say is this: how does a decision made in Threadneedle Street or in the Treasury end up in the mortgage payment of a household in Manchester or in the working capital facility for small business in Birmingham? That is the chain I want to make visible. Before I go into detail, I want to display the numbers that matter most right now. Bank rate sits at 3.75% following the Monetary Policy Committee's decision to cut by a quarter of a percentage point, and that was a close call, 5 votes to 4. Inflation is at 3.3%. It is falling, but it remains above the 2% target, and that gap is why monetary policy is still restrictive. On the fiscal side, Budget 2025 commits to over £120 billion of additional public investment across this Parliament. The tax burden has reached 37.7% of GDP, the highest in 70 years, and the FSCS deposit protection limit remains at £85,000 per depositor. These numbers are not abstract, they are the policy inputs that determine what a mortgage costs, what a savings account pays, and how much credit a small business can access. The Bank of England's Monetary Policy Committee sets the bank rate under the operational independence granted by the Bank of England Act 1998. Its sole mandate is price stability, defined as 2% CPI inflation. Every 6 weeks or so, 9 members of the MPC vote on whether to raise, cut, or hold the bank rate, and their decision radiates through the economy via 5 transmission channels. The interest rate channel is the most direct. When bank rate rises, the cost of variable rate mortgages and personal loans rises with it. The bank lending channel works through the willingness and capacity of banks to extend credit. As their own funding costs increase, so does the price at which they lend. The asset price channel operates through property and financial market values. Higher rates depress house prices and equity valuations, reducing household wealth and business collateral. The exchange rate channel affects the sterling's value. Higher rates tend to attract capital inflows, strengthen the pound, and reduce import prices. And the expectations channel, arguably the most powerful of all, works through credibility. If firms and households genuinely believe inflation will return to 2%, they moderate their wage demands and pricing behavior, and the work is half done. 2 institutional backstops underpin all of this. The Financial Services Compensation Scheme protects depositors up to £85,000, and the Bank of England's role as lender of last resort, the principle that it will lend freely against good collateral in a crisis, provides the systemic insurance that keeps the banking system functioning under stress. Budget 2025, titled Strong Foundations, Secure Future, was delivered on the 26th of November 2025. It is a materially expansionary budget, and that matters for monetary policy because fiscal expansion and monetary restriction are, in effect, pushing in opposite directions. On the measures side, over £120 billion of public investment, a national wealth fund that has already deployed £3.8 billion, and a gilt assurance programme of £303.7 billion for this financial year. That level of gilt supply places upward pressure on yields across the term structure, and because fixed rate mortgage pricing follows swap rates, which track gilts closely, this means the relief that households might expect from bank rate cuts is being partially offset by fiscal-driven yield movements. For firms, the increase in employer national insurance contributions to 15% from April 25 raises the cost of employing staff, a headwind to growth and a source of cost-push inflationary pressure that the MPC must account for. For households, the rise in the national living wage from £12.21 to £12.71 improves the affordability position of lower paid workers. But frozen income tax thresholds mean that, for most earners, fiscal drag is quietly eroding real purchasing power. The dividend tax increase of 2 percentage points will also reshape how owner-managed businesses extract profits, an important flow that feeds back into savings and investment behaviour across the retail banking market. For the executive team in the room, much of this will be familiar territory, but it bears restating clearly. Standard retail lending products must disclose an annual percentage rate under the Consumer Credit Act 1974 and the FCA's Consumer Duty, introduced in 2023. Fixed rate mortgages are priced off swap rates. Trackers follow bank rate directly, and variable rates, including standard variable rates, move at lender discretion, though the FCA has been explicit that asymmetric pass-through, where rate rises are passed to borrowers faster than they are passed to savers, is a conduct concern it takes seriously. The competitive landscape has shifted materially. Challenger banks, Monzo, Starling, Revolut and others operate with lower cost bases and more agile technology, and they reprice savings products in near real time. Open banking, delivered through the revised Payment Services Directive, allows third parties to access customer account data and build competitive products on top of it. The consequence is that legacy institutions can no longer rely on customer inertia to protect deposit margins. Budget 25's investment agenda, if delivered, creates a meaningful SME lending opportunity, and challengers are well positioned to capture a share of it through digital onboarding and faster credit decisioning. The scale of Islamic finance in the UK is frequently underestimated. The sector is valued at over £6 billion, with banking assets reaching $11.4 billion at the end of 24, a 38% increase year on year. The core principle is the prohibition of riba, or interest, alongside the avoidance of excessive uncertainty and investment in prohibited activities. This means products are structured around asset ownership and profit sharing rather than debt and interest. Murabaha is a cost plus resale. The bank buys an asset and sells it to the customer at an agreed margin paid in installments. Ijara is a lease-to-own arrangement widely used for home purchase plans by providers like Al Rayyan Bank and Gatehouse Bank. Mudaraba is a profit-sharing contract for savings and investment, and Takaful is the mutual pooling-based alternative to conventional insurance. In December 2021, the Bank of England became the first Western central bank to introduce a Sharia-compliant liquidity facility, resolving a long-standing structural disadvantage for Islamic banks that could not access the sterling monetary framework on equal terms. These products are open to everyone, not exclusively to Muslim customers, and their ethical underpinning has attracted a growing non-Muslim audience seeking value-aligned finance. The payments landscape is undergoing a structural shift that the Bank of England describes as a move towards a multi-money ecosystem. Crypto assets like Bitcoin are speculative instruments with high volatility. They play a negligible role in everyday retail transactions. Stable coins are more relevant. Designed to maintain a fixed value, they could function as retail payment instruments or wholesale settlement assets. In November 2025, the Bank of England published its proposed regulatory framework for sterling-denominated systemic stablecoins, requiring issuers to hold 60% of backing assets in short-term UK gilts and 40% as unremunerated deposits at the bank. Temporary holding limits for individuals and businesses are proposed to manage financial stability risk during transition. Tokenized deposits are digital representations of conventional bank deposits on a distributed ledger. They remain bank liabilities and are protected by the FSCS, making them the safest form of digital money for retail users. And the digital pound, a potential central bank digital currency, is in active design. The bank launched its Digital Pound Lab in August 25. A joint decision with the Treasury on whether to proceed is expected in 26, and the earliest it could be introduced is the second half of this decade. Critically, its design protects privacy. Neither the government nor the bank would access personal data through the core infrastructure. This slide maps the budget's individual measures to the affected populations, the transmission route and the net impact. I want to highlight one row in particular. The gilt issuance programme of £303.7 billion this year places direct upward pressure on the yield curve, and that pressure flows straight into fixed rate mortgage pricing. So even as bank rate comes down, the relief for fixed rate borrowers is being dampened by the sheer volume of government borrowing. That tension between monetary easing and fiscal expansion is the defining feature of the UK economic environment right now. Let me bring this together with three conclusions. First, monetary conditions remain restrictive. Bank rate at 3.75% sustains elevated borrowing costs across mortgages, consumer credit, and SME lending. The MPC is on a gradual downward path, but geopolitical uncertainty, particularly around energy prices, means that path is not preset. Households and businesses should not expect rapid relief, and the asymmetric pass-through of rate cuts to savings products is an issue the FCA will continue to monitor closely. Second, Budget 25 complicates the disinflation path. The fiscal expansion is welcome for the long-run growth. The OBR estimates a GDP uplift of over 0.5% after 10 years. But in the near term, gilt issuance pressures the yield curve, employer cost increases feed cost-push inflation, and frozen thresholds erode household purchasing power. The MPC and the Treasury are not, in the short run, pulling in the same direction. Third, competition is fundamentally reshaping retail finance. Challenger banks, open banking, Islamic finance providers operating in a regulatory environment now designed to support them, and the emerging stablecoins and tokenized deposits, all of these are competing for the flows that Budget 25 is redistributing. Conventional institutions that do not respond to this competitive pressure with genuine product and pricing innovation risk losing ground that will be difficult to recover. The chain from policy to market to household is real, consequential, and, as this briefing has tried to show, entirely traceable. Thank you for your time.